Good morning, ladies and gentlemen. Matt McGlay here. Gold, 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 and more gold. In today's video, we're going to be covering gold reserves and production of countries. On top of that, we're going to dive into how gold correlates and affects economies and the stock market. And then finally, wrapping it up, we're going to explore gold ETFs and stock companies that either mine gold or invest in the physical asset of storage of gold. Gold. There's something about it. When you hold it in your hand, you're not holding it. It's holding you. Maybe that's why gold has been used as a currency since the dawn of civilization. Let's take a look at how much gold there is in the world. As of 2017, the World Gold Council says that there is 190,000 tons of gold. That's a 21 by 4 meter cube. What does that look like? Well, here, check this out. That can easily fit into a Olympic-sized swimming pool. Might be sticking out a little bit, but yeah, that's a truck on top of that cube of gold. And if you look real carefully, you see that little sphere that's in front of the person sitting on the couch made of cash? That right there weighs exactly 1 metric ton of gold. Right there, we're looking at all the gold that's been harvested in the world. Pretty crazy, right? But you know what's even more crazy? All currency used to be backed by gold. Not anymore. So how much would gold be if we still backed all of the currency in the world with it? Well, let's take a look. As of right now, it's 2020. The world debt is around $257 trillion. So we have 190,000 tons. There's 32 ounces per ton. So that means that 190,000 tons, that's roughly 6 billion ounces of gold. So for the gold price to be equivalent to all of the debt that we currently have in the world, the price of gold would have to be around $42,000 per an ounce to equivalent to $257 trillion that the world has in debt right now. All right, let's take a moment to look at a few of the global reserves and production. As you can see here right now, as of 2018, China is pumping out gold. They're the number one producer of gold, followed by Australia and Russia, then the United States. It wasn't until long ago that South Africa back in the 70s was producing more gold by magnitudes compared to the rest of the world, but they've tapered off their production, and now they're around the eighth in production for gold. When it comes to total gold reserves, that's how much gold the actual country is holding. U.S. by far has more gold than everybody. I think, if I'm not mistaken, they have more than the top 3 combined. Notice what percentage of their foreign reserves that they hold. The U.S. is around 75. The France and Germany are around the 70s, you know. And then take a look over here at China in the right side. We have 2.4% of their currencies in foreign reserves. Same with Japan and Russia. So keep that in mind. That's why Japan and China and Russia are buying so much gold, is that their reserves are really dependent on other countries, especially the US dollar, and that exposes them to a lot of risk to be manipulated and to have the dollar used as a weaponized force against them. If we take a look here, we're going to see some of the top producing mines in the world. The number one mine is South Deep Gold Mine in South Africa. So no surprise, look at that. 2 of the top producing mines in the world are in South Africa. So South Africa also, keeping in mind, has 35 large-scale gold mines currently in operation. The country contains about 11.5% of all gold reserve that hasn't been mined. You're going to see over here in the U.S., we have the Cortez Mine and the Carlin Trend Mine. Both of these are in Nevada. It's something around 74% of all gold mined in the U.S. is mined in Nevada alone. You can see Australia is in the lead here with around 10,000 gold reserves. South Africa has around 6,000. The United States, 3,000. And then in China only has about 2,000 tons of gold that it hasn't mined yet. You know, Canada has more than that. And Canada has glaciers that are, starting to recede and revealing a lot of gold. It's very interesting when it kind of puts it into perspective when you look at this. Gold is one of the fundamental currencies. There's even talk of going back to the gold standard or potentially using it. A few countries in the past have tried to use the gold standard in recent years, within the last 20 years. didn't go too well for them. America kind of invaded them or toppled their government, but still, it's something that holds a lot of value and it's prized after. Everyone keeps it in the back pocket just in case. Let's take a look at the correlation between the S&P 500 and gold. Here on the right, I have a chart pulled up that shows the biggest decline in the S&P 500 since the 1970s. If we look here, we have 19.4% in March 1976. Gold went up 53%. We also have back in 2000, 49% decline. Gold went up 12%. In 07, 56% decline. Gold went up 25%, and silver went even up a little bit here. So there are a couple anomalies. As you see, it's not foolproof. We look back in the 80s, S&P crashed and so did gold. But in general, gold serves as a hedge against inflation and also the declining stock market. When the market's going down, people take money out of it and start putting it into gold, which is a safer investment on the return. But once the market starts rising again and we're in a good bull market, everyone's happy, everyone starts selling off their gold and investing it into higher returns. On top of that, we can see correlations between gold and other currencies. For example, the Swiss franc. If you notice here, they're completely inversed. When the Swiss franc is going up, gold is going down. When gold is going up, the Swiss franc is going down. But then another pair, for example, the Aussie dollar, are also correlated, but in a positive manner. When gold goes up, so does the Aussie dollar. One of the reasons to keep that in mind, as we viewed earlier, Australia produces a lot of gold. So it's safe to say the dollar is hypothetically pegged to the gold. If gold is such a secure investment, why don't I just hold 100% gold and nothing else? Well, this is where it gets a little tricky. So historically, if we look back, let's say, all the years back to, around 1916, we can see that the S&P 500 and the general stock market, the Dow Jones, it outperforms gold by far. We're talking 50,000% compared to, a maximum of 8,000% return, if you bought it all the way back down here. But once we start kind of tightening the time frame, we go back 30 years, gold becomes very competitive. We see that gold is about matching. Gold even outperformed the Dow Jones around, 2011. But still, you get a better return around, 2020, if we look at that. But if we start moving it in more average, we start getting closer, we start looking at the 10-year, we start seeing how gold is creeping up. And gold now is really, in the last 5 years, is starting to compete with the Dow Jones Industrial Average. And as of February, gold is actually outperforming your returns on the Dow Jones Industrial Average. So this is a concept to kind of keep in mind. The thing with gold, though, is where gold is very valuable and it comes in hand is when the market starts crashing. As ideally we discussed, it's a hedge. It's a way for investors when the dollar becomes either the dollar loses its value or the stock market's insecure or we're not certainly sure what's going on in the market. People pull out of the market and they put it into gold. They do that to keep their money safe. It's kind of like, not everyone's exactly doing it for this reason, but think like if the world goes to end and the US dollar loses its value and people are, you got a wheelbarrow full of, US dollars and somebody robs you, pushes the wheelbarrow over with all the money, then takes the wheelbarrow and runs off, right? It's kind of like that type of scenario. Let's move on to our final and last topic. Let's move on to what this has all been about. Talk a lot about gold. Talk about gold mining. We talked about production. We talked about its correlations to the stock market. But Matt, how do we actually invest in gold? Well, there's a couple of ways. You can buy physical gold, which is always great to have. There's something about just holding gold and having a little bit of it just in your hand. It just feels right. But you're not going to get the kind of leverage that you would obtain through investing within the market. And I gotta be careful with that because when you're using leverage, higher risk, higher reward. And that's purely for you to decide how much you're willing to take on. But once again, it's always nice just to have a little bit of gold. So when it comes to gold, you have various companies. For example, you have a lot of ETFs that specialize in holding just gold themselves. For example, the SPDR Gold Share, or the ticker, just GLD. They hold approximately 915 tons of gold as of late 2019. Although one of the things to keep in mind is that these ETFs and companies are purely pegged to the gold. So if gold goes up 5%, this company is probably going to go up around 5%. That's why investors looking for a higher margin and profit tend to sway towards mining companies. Let's suppose a mining company has a profit margin of around $200 when the price of gold is $1,000. Let's say the price of gold rises 10% up to $1,100 an ounce. An ETF would, go up around 10%. But the operating margin of the gold miner goes up to $300. That's a 50% increase in their profit margins, which correlates directly to the price of their stock. Although, the same inverse goes down. When gold goes down, their profit margins go down. So it's a double-edged sword. And of course, there are other issues to consider with gold mining stocks, namely the political risk. Think about what's going on in South Africa right now. There's a lot of trouble and turmoil in there. Droughts, famine, potential wars. Think in places like Indonesia. What if there's a government change? Right now, they tend to be positive and bring in people, but things happen, And if there's a gold mine in one of these companies that's having a lot of discourse, that's going to affect the price of that gold mining stock. So those are some things to keep in mind when you're looking for which companies you want to invest in. Whether it's looking at a company that is in a new region that's becoming very pro gold mining and is bringing in other foreign companies to invest into their gold, or the opposite's happening. Hey guys, hope you had fun and enjoyed the video. If you found it of value, help me out and hit that like and subscribe button. If you want to follow me on my other social media sites, check me out on Twitter and Instagram at Matt McGlay. Link in the description.